Everything being reported about the Iran agreement over the weekend misses the core reality. The issue is not a minor misunderstanding or a lack of context. The central premise being presented is incorrect. The common narrative says that Trump entered the Situation Room, left without making an announcement, and simply postponed a decision while considering his options. What actually occurred was different. Trump did not merely delay approval, he altered the framework itself. The proposal was returned to Iran with stronger language. Two specific areas were revised. The first involved the future handling of Iran's nuclear material. The second concerned the exact terms governing the reopening of the Strait of Hormuz. The version that negotiating teams from both sides had finalized on Thursday is no longer the active document. A revised text now exists, and Iran must determine whether to accept the new conditions, reject them outright, or enter another negotiating phase. Two U.S. officials, along with a senior administration source, independently confirmed this sequence of events. What financial markets had been treating as a nearly completed agreement awaiting a signature has become something substantially different. The process has returned to active negotiations. This distinction is significant for anyone tracking gold and silver during the coming week. To understand why, it is necessary to examine the sequence of developments and what changed between Thursday and Friday. The first confirmed fact is that representatives from both sides reached agreement on a 60-day memorandum of understanding. The purpose was to extend the ceasefire and begin nuclear discussions. This occurred on Thursday. Two U.S. officials confirmed the arrangement. A regional mediation source also verified it. Axios was first to publish details regarding the terms. By Tuesday, the agreement was widely described as essentially complete. Both parties indicated that approval from senior leadership had been secured and that signing could proceed. The second confirmed fact concerns Friday morning. Before entering the Situation Room, Trump publicly stated, through social media, that he was preparing to make a final decision. He outlined several requirements. Iran must never obtain a nuclear weapon. The Strait of Hormuz must reopen immediately with unrestricted shipping and no transit charges. All mines must be removed. No funds would be exchanged until further notice. He then attended a meeting lasting 2 hours. Afterward, no announcement was made. The third confirmed fact emerged on Saturday morning. The New York Times reported that Trump returned the framework to Iran with revised conditions. He neither approved nor rejected the agreement. Instead, he modified it. The revisions specifically strengthened language concerning Iran's nuclear material and adjusted the wording related to reopening the Strait of Hormuz. The updated document was delivered to Tehran. Negotiations that many market participants viewed as complete have now entered another phase. Multiple sources indicate that this process could continue for several more days. The fourth confirmed fact occurred during the same period in which diplomatic teams were completing text discussions in Doha and Oman. Iranian air defense authorities stated that they had shot down a USMQ-9 Reaper drone near the Strait of Hormuz. According to Iran, the Arushik Amir system carried out the interception. Officials described the event as evidence that Iran continues to possess effective military capability despite months of conflict. The claim has not been verified by the United States. Nevertheless, the timing of the announcement during the most sensitive 72-hour period of the diplomatic process carries an unmistakable message. The fifth confirmed fact also took place that same day. The U.S. Treasury Department imposed sanctions on the Persian Gulf Strait Authority. This organization had been established by Iran to oversee passage through Hormuz and collect associated fees. Targeting that specific institution during ongoing negotiations sends a clear signal. The United States applied financial pressure directly against the mechanism Iran created to support its position regarding control of Hormuz. Both developments, the drone claim and the Treasury sanctions, occurred on the same day as the Situation Room meeting that concluded without an agreement. The sixth confirmed fact followed shortly afterward. Iran's military leadership reaffirmed its authority over the Strait of Hormuz and warned both commercial and military vessels that Iranian transit regulations must be followed. That declaration came after the meeting ended without any public announcement. The seventh confirmed fact involves statements made by Trump on Saturday. While the revised framework was on its way to Tehran, he publicly stated that the United States possessed all the leverage in the negotiations. He also expressed regret regarding the way the conflict with Iran began, while continuing to defend the U.S. military action that initiated it. Both positions were presented simultaneously. He continues to seek an agreement. However, he now seeks one based on terms different from those accepted by his own negotiating team. When these 7 confirmed developments are arranged in chronological order, a different picture emerges. This is not an agreement waiting for a signature. It is a negotiation that effectively restarted on Friday night. The process is now operating under a new timeline, based on revised conditions that Iran has not yet accepted, rejected, or formally answered. That distinction becomes critical when evaluating the outlook for commodity markets, particularly gold and silver. The diplomatic story and the market story are connected. And the difference between a delayed agreement and a renegotiated agreement creates two entirely different scenarios with two different timelines and two different potential outcomes. Trading ended on Friday with what independent analysts identified as a powerful short covering rally. Prices rebounded sharply after touching consecutive 2-month lows, following the completion of a major institutional paper liquidation cycle. Gold finished the week near $4,541 per ounce. Silver ended near $75.24 per ounce. The recovery was genuine. However, the force behind that move was optimism surrounding a potential agreement. More specifically, the catalyst was Thursday's confirmation that negotiators had reached consensus on the terms. What traders incorporated into prices on Friday afternoon was the expectation that a signed agreement was close at hand. What now confronts the market at the Sunday night Globex opening is a different situation. The framework was returned with stricter conditions, and the timeline has been pushed back by at least several days. Paper markets closed based on confidence in an approaching deal. The diplomatic situation now stands further away from a signed agreement than it did when that optimism entered prices. The disconnect between market expectations and diplomatic reality may become the central theme of Monday morning. Yet the situation is not simply negative for silver. Beneath the paper market, two separate sources of demand remain active. Neither depends on the signing of an Iran agreement. Both strengthened during the week. The first source is demand for physical delivery. The COMEX May delivery totaled 6,414 contracts, equal to 32.1 million troy ounces. That figure was 93% higher than April's pace. Industrial purchasers, unable to secure silver through normal supply channels after 13 weeks of disruption in Hormuz, have been taking physical delivery through COMEX at a rate without recent historical precedent. The July contract currently carries 71,614 contracts of open interest. That represents 358.1 million potential delivery ounces. Registered deliverable silver, stored in COMEX vaults, stands at 84.1 million troy ounces. July first notice day is 21 days away. Each additional day without a signed agreement means another day before industrial buyers can normalize supply chains. Every day of uncertainty adds pressure to the approaching July delivery cycle. A framework returned for further negotiations does not lessen that pressure. It increases it. The second source of demand comes from central bank accumulation. China's central bank has now added gold reserves for 18 consecutive months. Its April purchase totaled 260,000 troy ounces. That was the largest monthly increase since January 2025. Gold now accounts for 8% of China's total foreign exchange reserves. 3 years ago, that figure stood at 3.4%. During the first quarter of 2026 alone, central banks worldwide added 244 tons of gold. This long-term acquisition program does not stop because Trump returned the framework to Tehran. It represents a multi-year reserve strategy operating on a completely different schedule from you. Iran negotiations. The support created by this structural buying, estimated at approximately $4,200 to $4,400 per ounce, is not dependent on any agreement. That support exists independently. It was reinforced on Friday when gold rebounded strongly from its 200-day support level near $4,355 per ounce. This creates a clear picture heading into Monday. Paper silver finished the week based on optimism surrounding a deal that now appears less certain than it did on Thursday. Physical silver delivery pressure continues building toward July, and the renegotiation process extends that timeline. Gold retains structural support, while central bank purchases continue regardless of diplomatic developments. The conflict between paper pricing, driven by diplomatic sentiment, and physical markets, driven by supply chain realities, forms the central trading setup of the week. 3 developments deserve close attention before considering what may happen next. The first is Iran's response to the revised framework. The renegotiated proposal has already been returned to Tehran. As of Sunday evening, no public response has been issued. Acceptance of the revised conditions, even through private mediation channels, would significantly alter the outlook for the week. A public rejection would create a different outcome. A counterproposal would launch yet another negotiation cycle. The absence of any response also carries meaning. Each passing hour without a public statement adds uncertainty. Meanwhile, the paper-silver market must continue holding Friday's closing level under those conditions. The second development involves the U.S. Treasury Department's position toward the Persian Gulf Strait Authority. Sanctioning that organization on the same day as the Situation Room meeting was deliberate. It communicated a message. If the Trump administration follows those sanctions with additional financial measures targeting Iranian maritime infrastructure during the renegotiation period, it would indicate that Washington is negotiating while simultaneously increasing pressure. Historically, that combination has been the most consistent U.S. negotiating approach across major sanctions disputes during the past 20 years. The third development to watch is the registered COMEX silver vault figure on Monday morning. If vault holdings rise while paper prices remain under pressure, it suggests physical demand is absorbing weakness in paper markets. If vault holdings decline while paper prices remain under pressure, it indicates delivery demand is exceeding incoming supply. The difference between those two outcomes may reveal more about actual supply conditions than any diplomatic headline. Stepping back from immediate developments reveals a broader framework surrounding this week. Whether the Iran agreement requires 3 days or 3 weeks, it is unfolding within a larger structure that may define the second half of 2026. 3 months ago, before the first ceasefire, before the April delivery shock, and before the ongoing diplomatic exchanges, the silver supply situation was already facing structural strain. Multiple official industry reports independently verified a supply deficit measured in the hundreds of millions of troy ounces. Before the conflict began, the registered COMEX vault inventory had already been declining from its October 2025 peak. Demand from solar production, electric vehicle battery manufacturing, and advanced electronics continued expanding faster than mine output could support. That was the starting condition before the war. The conflict involving Iran added a physical supply chain disruption on top of an already strained structural environment. For 13 weeks, disruption in the Strait of Hormuz forced industrial procurement teams to seek silver through COMEX physical delivery because traditional supply routes were affected. That is why May delivery volumes reached 93% above April. That is why July open interest stands at 4.3 times the size of the entire registered deliverable inventory. The pressure visible within COMEX is not simply a wartime trade. It reflects an existing supply deficit expressing itself through the delivery system after conventional logistics channels were disrupted. The critical point is this. When the agreement is eventually signed and both parties continue indicating that they want an agreement, while most terms are already accepted and only language revisions remain, a 30-day mine clearing period begins. After those 30 days, the Strait of Hormuz reopens to commercial shipping. Several weeks later, supply chains gradually return to normal operations. However, the structural deficit that existed before the conflict does not disappear when the first vessel passes through Hormuz again. Industrial procurement managers who accepted COMEX delivery at a pace 93% above normal during May will not suddenly stop requiring silver once Hormuz reopens. They will simply regain access to standard supply channels. The demand remains real, the supply shortage remains real. The signing of the agreement becomes a catalyst for a price path that the structural environment was already pointing toward rather than a limit on that movement. One development from this week received little attention. During the same period that Trump returned the Iran framework with revised language, Iranian officials traveled to Doha for a second consecutive day of discussions. The focus was the release of $12 billion in frozen Iranian assets through talks with Qatar's prime minister. Iran's central bank governor personally attended those meetings in Doha. The purpose was to address asset release arrangements as part of a broader agreement. That detail is important because it reveals Iran's practical negotiating position. Iran is not abandoning the agreement. Iran is not rejecting the framework. At the same time that Trump is revising language concerning nuclear issues in the Strait of Hormuz, Iranian officials are participating in discussions regarding asset release logistics. Both sides remain engaged across multiple negotiating tracks simultaneously. The return of the framework with revised language represents a negotiating step rather than a collapse of talks. The continuation of financial discussions in Doha, while wording related to nuclear matters in Hormuz is being revised, indicates that the broader framework remains intact. The revisions concern language on the most difficult issues. They do not concern whether the agreement itself exists. Ultimately, that is what markets are expected to price, not the temporary delay caused by renegotiation, not the tougher wording. Instead, the focus is on the eventual convergence of two parties that both seek an agreement, continue active discussions across all channels, and remain separated by language adjustments rather than fundamental incompatibility. The timeline became longer on Friday night. The destination remained the same. Going into Monday morning, the broader picture looks like this. Gold ended the week at $4,541. Its 200-day structural support level near $4,355 was successfully validated on Friday. Silver closed at 75.24. It remains inside a technical compression wedge, bounded by its 20-day moving average at 76.90 and its 50-day moving average at 75.42. The gold to silver ratio stands at 60.35. That remains within the historical equilibrium range of 60 to 65. Friday's closing move reflected an institutional short covering rally following completion of a major paper liquidation cycle. Monday's opening session now carries the additional weight of ongoing renegotiation against that completed liquidation backdrop. There is a specific term that describes this setup. Institutional paper selling has already run its course. Physical delivery demand continues building toward a 21-day first notice day clock. Central bank accumulation has continued uninterrupted for 18 consecutive months. At the same time, both parties in a diplomatic dispute continue seeking an agreement while negotiating on all tracks simultaneously. That term is compression, not breakdown, not collapse, compression. The type of compression that eventually releases once final wording is accepted and signatures are placed on the document. As of the 31st of May, 2026, all information reflects publicly confirmed data available at that time. Continue monitoring developments closely. Watch for Iran's response to the revised framework, follow changes in physical delivery demand, and track the signals emerging from the broader market structure as the negotiations move forward.